Welcome, friends. In this edition of CA paper, Advanced Financial Management, Paper 2, CA Final Level, ICAI Ashish Gupta, Joint Director, Board of Studies, welcomes you all. Now, student, in this today's session, what we are continuing our discussion on the topic of derivative analysis and valuation. Of course, there is one topic has been left, and that is real option valuation. Now, student, as in our earlier classes, we have gone through with the basics of the financial derivatives. We have covered what are their basic natures, what are their types, and even valuation also. There is one important concept, that is option, that we have discussed in our earlier classes. Now, in today's session, it is one of the very important topic because it is not from the academic point of view, it is also very important from the strategic decision making point of view, because company has to take some decisions and use this technique, real option valuation. Now, student, with this we start our discussion. As you know that you can ask your queries during the session or after the session. So let us start our discussion. Okay, student, now let us start our discussion. अशोक जी, परमिशन देना जरा शेयर स्क्रीन पे. Sorry. Now, student, when we talk, just let me see if there is okay. Of course, there is some chat. Good morning, Jeannie. Good morning, sir. Please provide your contact number and email. Stephen, yes, I will share with you my contact number. In the end, I will share with you. Okay, don't worry. Okay, if you have any query, you can send me through the chat right now. So, student, when we talk about the topic of real option, just I'll briefly take you to the topic of the option. Now, when we talk about the real options, what does it mean? Option in reality scenario. Okay. Now, when we talk about the option, you remember that this is a choice or right, not an obligation to buy or sell and underline. Now, when we talk about the underlying, here our underlying till now what we have discussed was generally stock, index, commodity, and now in the next forthcoming classes we shall see foreign exchange and interest rate. Generally, these are the financial underlyings. Okay, but when we have to apply the same logic in our capital budgeting decision, then it becomes the real options. Now, student, if you remember, when we are talking about traditional capital budgeting, there are some, we can say, there are some assumptions that the capital budgeting decision cannot be reverted. If you recall that capital budgeting decision cannot be reversed. Okay. So, but here, when we will talk about real option, we will devise this assumption. Because what happens when we, because of this assumptions, these type of assumptions, normally what happens, we ignore the dynamics of the capital budgeting decisions, and we assume that our capital budgeting decision is a kind of a static decision that we have once taken, we cannot revert it. But real options provide a scope for this dynamism. What are the dynamism? Because we assume that sometime if we are not finding the project viable, what we can do, even we can ignore, we can abandon the project. This will be can be also be the situation. Okay, student. So now let us see how we can proceed further. So we can say that it is just like, okay, now let us see the number. See, now question rises, how many, what type of capital budgeting decisions we can undertake? What can we, how we can use the real options in our capital budgeting decisions? Okay, of course, in study material where various options have been given. Now let us try 3 or 4 cases that are not practically used and that are widely used. Okay, so first we are discussing option to expand. Okay, sometimes what happens, uh, once we have taken a capital budgeting decision, generally in traditional capital budgeting decisions, we used to carry out an analysis of only one capital budgeting decisions at one time. But it may be possible that this capital budgeting decision may also allow us to expand further our operation. So this is kind of a right or a choice that is attached with this capital budgeting decision. So what happens when this type of choice is attached with capital budgeting decisions? So we can value our option. How we can, that is what is the value of this right or choice. Even sometimes what happens, it also allows us to enter into the new market. Because it may be also possible that our NPV may be negative with the present capital budgeting decision, but since it is allowing us to enter into new market or expanding our operation, then we may consider it. Yes. So what happens normally, we may say that our since our NPV negative, we may reject the decision, because if we go by the traditional capital budgeting decision, what happens if our traditional capital budgeting decision says if NPV is positive, then we say yes to project. If NPV is negative, we say no to project, or it is equal, we can say. But here, what happens, even in this situation, we may go for the capital budgeting decisions. The reason is that we may say that, yes, of course, we want to go for it because it will allow us to enter into the new market where our NPV can be positive. Okay, so we can consider our negative NPV as call premium that will give positive NPV in future. Now, when we see how diagrammatically we can present it, then you will understand how we can link it to a call option. Okay, now let us see the diagram. Now here, this is our suppose we have thought of a project, okay, whose NPV is negative. So we can say that it will be negative till we invest into the new project. Okay. So ultimately, whether we invest in new project or not, our NPV will remain negative. But once we start investing in the new project, then it may be possible that our future NPV may become positive. Okay, so this will be our expansion stage. Okay, now if you see this diagram, you will say, sir, oh, sir, it is the diagram which is just similar to the call option. Okay, so it is a, we can say that we can equalize option to expand, like we can say that it is a call option. Okay, student, clear? Nisha Patil is saying, sir, your voice is not clear. अशोक जी वॉइस क्लियर नहीं है क्या? एक मिनट रुकिए, मैं देखता हूँ। मैं अब सही आ रही है, मैं ठीक है, मैं इस एडियो करके करूंगा, ठीक है ना? या इसको मैं माइक को देख लेता हूँ, 1 सेकेंड। ओके okay friend, now negative NPV, we have seen that it is a kind of a call option. So you can see that it is just like a financial option, but with the difference is that here our underlying is a, or where our premium is a negative NPV. Now we come to option to abandon. Student, if you recall that when I was talking about tradition in the traditional capital budgeting, we cannot dispose of the project. But here, sometime what happens? If we continue the project, our negative cash flow will be the more than our, or we can say that even our cash inflows are meeting our expenses. So in that case, it may be viable option that we abandon the project. Sometime what happens, if we abandon the project, we may get some salvage value, or even our competitor may be ready to buy our project. So in that case, we also get an option. So we have to see how we value this option. Now let us see again by the way of diagram. Now it may be possible that we may have a negative NPV when we are just using our simple project. Okay, that simple what we are main project we are focusing. But it may be possible that we may be given an option that we may get this much of salvage value. Okay, or we can say it is can we can sell off value, disposal value. So in that case, we can see that even though our negative NPV is there, but it will convert into the positive cash inflows this way. Okay, so when I equalize this diagram with one of your financial option diagram, please answer me to which it resemble. Student, I expect the answer from you. The same diagram we have used in the financial option. Just let me know which diagram it is same as diagram we have used in there. Yes, very good, Ginny. Your answer is correct. One or two answer I'm more expecting. I just yes, Sahil, you are right. Okay, student. Now, if you recall that it is similar to put option. Okay, we can say it is equal to long put option. Okay, that is the buyer of the put option. Okay, so this is the profile is matching with the profile of the put option buyer. So we can say that our option to abandon can be equalized to put option. Okay, student. Now we come to the our third option. That is option to wait. Generally, in the traditional capital budgeting, we are given the option like go or not go option. Okay, either you accept the project or reject the project. There no other option were there in a traditional capital budgeting. Okay, so contrast to it, in our real options, we are given the option to defer the project to a future date or delay the project. Because it may be possible that in future time, the conditions may be favorable. And generally, these type of options are used when the company or the firm has an exclusive right, because otherwise a competitor may take the opportunity. But sometimes you have some exclusive right, or you can say monopoly type of a right, that either you can install the project now or you can defer it for the future period. Okay, for example, I just give you an example how it will look like. Suppose a project has a perpetual cash inflow of rupees 100 in perpetuity, and initial investment is rupees say 1200. Okay, and our discounting rate or WAC is 10%. If I say you whether you should accept the project or reject the project, now let us see the answer. Since our cash flow is in perpetuity, to determine the cash inflows, present value of cash inflows, we divide annual cash flow divided by the PV factor, that is percentage of the discounting or WAC minus initial investment. Okay, our NPV is negative 200. So we say no to project. Now suppose after 1 year, discounting rate comes down to 5%. Then what will be the situation? The situation will be completely changed, and it will be 800. So now we shall say yes to project. Because of this change in discounting factor, we are saying yes to project. So it may be possible that tomorrow the same conditions may not prevail. Accordingly, we can change our decision or we can defer our decision. So this is the main one of the type option where we have to wait for what some time. We can say we can defer the decisions. Okay, now when we defer the decision, now let us see the diagrammatic presentation. If we see After 1 year, it may be possible that this NPV will become positive because of discounting. So we can say that this payoff profile is also matching with the our one of the profile, that is our call option, long call option. Accordingly, we can say that our option to wait can be equalized with the call option. Okay, friend. Now clear to you how you can see how we are linking our financial option concept that has been covered in earlier class with the real options decisions. Okay, then there is another decision. Strategic options. Now these are options are very widely used because here are many companies have to take some strategic decisions and they have to consider decisions from the various point of view. Generally, because sometimes what happens, the company may look into to explore into the new market. So there they have to analyze whether we should go for the decision or not, because it may lead to the failure of the business as well. And even some very this option are widely used in two cases. One is an R&D, research and development, and patent valuation. The reason is that in R&D and patent valuation, generally a lot of investments are involved, and it may be possible that R&D may not be approved or maybe not be accepted by the we can say it is not accepted by the concerned authorities. Then it may lead to the failure of the, or we can say it is a kind of a sunk cost. Okay, whatever expenditure we have incurred. So here we can use this R&D and patent valuation. For this we can use the option valuation techniques. When we talk about this, generally uh, here it is considered as a call option, because generally it calls for, we can say in future we are taking it for the future period, we are taking a risk. Generally it is equalized to the call option. Okay, so broadly we can say that our on our analysis, if we combinedly say we can divide our analysis total into 4 categories. Okay, now option to expand, option to abandon, okay, option to wait, and strategic option. Now this case is equalized to the long call. This is equalized to long put. This is equalized to long call. And this is also the long call. Okay, now on that basis, we can value this option. Further, we can also say that NPV of, that is real option, is equal to NPV without an option minus option cost plus option value. This formula, very simple logic you have to keep in mind, because this portion is coming out from the option. This is a traditional NPV. Okay, now if we are getting any benefit, of course we have sometime we have to pay some prices. So we can say that if any extra cost is there, of course if negative NPV there, so then this is our premium. We can say that, and this is our option value. So this logic shall be applied everywhere in our questions. So now let us see in our study material as well. We have given the differences between the options. What are the how we say that financial options and real options are differ from each other. Let us see quickly see their differences. These differences are very important from to understand from examination point of view as well, and we can say application orientation as well. Now, student, let us see. First of all, we here consider our basis. On what basis we are considering, and here our financial options. And here it is real options. Okay, first of all, we see what are the underlyings. Okay, first we see the what are our underlyings. Now, in case of financial option, as you know that our underlyings are stock, bond, commodities, interest rates, electricity, weather, index, etc. Okay, whereas in case of real option, the underlying is projects, capital project. Okay, we can say capital projects. Now, when we talk about the payoff, okay, generally payoff is fixed. Okay, we know that if we have bought the call option, okay, so if the this much as price is there, we know the exercise price, and ultimately we can get an estimate that how much of our profit will be there. But here, what happens is based on cash flows, it could be varied. So we cannot exactly estimate the how much cash flow will be there because cash flow are likely to slightly change. Okay, so here it is, we can say that it is quite variable in nature. Okay, now next is comes exercise period. Okay, generally short period. Generally, in case of a financial option, you have seen that our options were the duration was 3 months, 6 months, maximum 1 year. Okay, whereas in real option it starts after 1 year. Okay. Okay, beta Pooja, welcome to the class. It starts after 1 year. Okay, and it has a longer period. Okay, generally capital busting projects are for the longer period. Okay, now next is how we approach. Here it is price. In case of financial option, we value the option, or we can say that we price the option for trading purpose. Okay. Whereas in case of real option, value to make strategic decisions. So you see here, it is a price. Here it is valued. Okay, because it is just we are making a value how much it is effectively useful. Okay, now last is trading. Can be traded because it is linked to the same prices. Because since it is priced, so we can go for their trading. Okay, cannot be traded because it is only valued. Because it is valued only for the strategic decision, it cannot be. So with this, we come to the end of the topic of the basics theory of the real option. Before I proceed for the assignment, if you have any doubt, you can discuss with me. Okay, student. Now let us start with our discussion of the assignment. The assignment has been uploaded for you, and now we start solving the assignment in the class. Now, just student, take 2 minutes and read this question. Then I start solving the same. Okay, student, this question has been adopted from our earlier IC examination. Now, this question says like that: Ramesh owns a plot of land on which he intends to construct apartment units for the sale. Number of units apartment to be constructed may either be 10 or 15. Total construction for these alternatives are estimated to be 600 lakh or 105 lakh respectively. It means if you are going for the construction of 10 houses, the cost will be 600 lakh. And if you are going for the construction for the 15 flats, the construction will be cost will 1025 lakh respectively. Now, current market price of each apartment is rupees 80 lakh. The market price after the year of apartment will depend upon the conditions of the market. If the market is buoyant, each apartment unit will be sold for 91 lakh. And if it is sluggish, the sale price will be rupees 75 lakh. The yearly rental per apartment unit is rupees 7 lakh per annum. Okay, assuming that the construction cost will remain same in year one, the and risk-free rate of return and determine 110%, you are required to determine if Ramesh decides to get constructed apartment now, then how many units he should construct it, that is 10 or 15. If Ramesh waits for the 1 year, then how many units, sorry, it print left as is how many units to be constructed, 10 or 15 in the given scenarios, because there are two scenarios, that is prices, uh, we have to see how the prices like that, because prices can be based on the market condition, buoyant condition, or the sluggish conditions. Okay, then in the last we have to compute the value of the vacant plot. Now, student, please note that if you see the whole scenario, then there is one method maybe come to your mind. Okay, if you recall that when we talk about derivative valuation,
Binomial.
yes, very good, very good. It is a binomial. Okay, so accordingly, we can say that one of the important method we can use here, the whole scenario is similar to like binomial option. Okay, so we shall use here the binomial model. So let us start first solving the answer one part by part. Then we proceed to our last part, that is what will be the value, because value of the vacant plot will be used by this method. Okay. Now first, let us see the first part. It says if he has to get constructed apartment now, so how many units he should produce? That is got constructed. That is 10 units or 15 units. Okay. Now see profit yield under each option, that is 10 or 15 units. Okay. Now if he construct now, okay, the current market price is 80 lakh. So units, okay, we are constructing 10 units. Sale price 80 lakh per unit. Okay, sales amount, it is rupees 800 lakh. Okay, cost, it is rupees 600 lakh. So profit, this minus this, rupees 200 lakh. True. Now we come to the next, that is if they want to construct 15 units, the price shall remain per unit same. Okay, so we multiply the same both, it comes 1200 lakh, and since our cost is 1025 lakh, okay, so our profit comes 175 lakh. If you are given a choice that how many units get constructed as on date, then what will be your answer?
10, sir.
10. Very good.
10.
Our option will be 10. So we should get constructed 10. Okay, this part I hope clear to you. We are coming to the second part. Now it says in a second, after year one, the cost will remain the same, no problem. But we have to determine then what will be our payoff. Okay, for this payoff, we draw out a properly table. Because here there are two conditions. It is very important to note that in addition to 10 to 12, that there are two more conditions are there, buoyant and sluggish. So accordingly, there will be the four options. Okay, student, now let us see what will be our different payoffs in the different scenarios. So first way I assume here I write 10 units and here I write 15 units. Okay, now conditions are here. If I assume the buy-in conditions, and here the market condition is sluggish. Now, if the market is buying, okay, so now let us see. Our sale price will be 91 lakh per unit. And if it is sluggish, it will be 75 lakh rupee per unit. It is normally, if you have observed that when the buyers are more, so properties prices are tend to be on higher side, whereas if the market is sluggish, so generally the sellers are more there and the properties prices are come down. So here, if I construct, Ramesh construct 10 units, 91 into 10, of course, as we assume that our construction cost shall remain the same. Okay, so our profit will be okay. If our market conditions are sluggish, so of course our the Ramesh flat will be sold at so rupees 75 lakh per unit. Accordingly, rupees 600 lakh. Then we come to the 15 units. So 91 price is there. Here it is coming 15 units minus rupees 105 lakh. 1 second, I think. Yes, it is 1025 lakhs. So the resultant figure comes
340.
yes 340 madam. Very good. Okay. 340 lakh. Okay, here it is market is sluggish. Okay, we have constructed 15 units. Then what is the answer?
100.
100. Yeah, very good, Peter. Okay, so we close our table. So now if we see our options, different options, that if how many units under each scenario means that if the market is buoyant and if the market is sluggish, then how many units we should Ramesh should get constructed. So suppose if the market is buoyant condition, then how many units Ramesh
15
should
units.
constructed?
15 units.
15.
Very good, beta. Now should produce he should get constructed 15 units. And if the conditions are sluggish,
10
10
units.
10
10
units.
units. Okay, student. So we can say that if market conditions are buoyant, then 15 units. And if market conditions are sluggish, then 10 units to get constructed. Okay, student. Now with this, our second sub part has been cleared. Now we are coming to the third part. Now when we talk about the value of the vacant plot, so here we shall see what are the various conditions are there, and we will determine the probability. Okay, because here our probability is missing. Now, if you recall the formula, or we can say the logic behind when we are using the binomial option model, when there are two possibility prices of a share price were there, that is up and down. So we used to use one method to determine the probability. What was this method? Just recall.
So risk neutral method.
Very good, beta. It was a risk neutral method. So we were using risk neutral method to determine the probability that what are the prices of the going share up and same down. So here we shall use the same logic here. Okay, to determine in binomial model, we were use the risk neutral version. Okay, because there are two models in binomial model. One is based on delta hedging. Okay, one we basis on the delta hedging. Okay, now let us draw a diagram. Today's price is 80 lakh of the per unit. Okay, just I draw a diagram. One second, students. Okay. Now here the possibilities are 91 lakh rupees. Okay, here our possibility is that 75 lakh rupees. Okay, now student, when we determine the value of the vacant plot, there is one more factor attached here is 7 lakh rupees rent per annum. Because now we see when we have to value the vacant plot. So we will value the option from the investor's point of view. Okay, now see here what happens. Now when we were valuing the option, finalization option, normally we were using the concept of replicating portfolio. That is today's I am investing say in a delta hedging. Not normally what we are using that today I am investing this much of share, that is delta into the number of share, delta share, and I am writing one call option. Accordingly, we were using the same logic. Now here, same logic will be applied, but now this time this logic will be applied from the investor's perspective. Now it says that today suppose one person has invested rupees 80 lakh. Okay, a person has purchased a unit of flat at 80 lakh. Now, after that 1 year, there are two possibilities are there. This will be the price will be 91 lakh, or this will be the price will be down this. But here, if we let out or she let out his or her flat for 1 year, he will also, in addition to get the rental income of rupees 7 lakh. Okay. So we can say, in addition to this capital gain or loss, there is one rental income of rupees. Accordingly, on a possible two notes, these are the two notes are important. Two notes are there. The cash flow is likely to be 98 lakh, and here it is likely to be 82 lakh. Okay, student. So as we use that, normally we assume that the price P is the probability. P is the probability of price rise. Then 1 minus P is the probability of the price fall. Okay. Now let us compute. If today I am investing 80 lakh rupees, okay, I am expecting a gain of rupees. Probability is that I will gain 98 lakh rupees at the end of first year, plus 1 minus probability of my inflow of 82 lakh rupees here. Since I am this amount I will get after 1 year, I will get it discounting by risk-free rate of return. Because I have been given the risk-free interest rate. Same logic I am applying that I have used in the financial option. Okay. Now just you compute the P beta. I'm just giving it to time. You just compute the value of P and let me know. Just send your answer on the chat only, because I want other students also try as well. Nisha, beta, my voice is clear now, or if still there is an issue? Yes. Anila, you are right, beta. Okay, beta. Nisha, you are. Anila, you are right, beta. Your option is right. Yes, Anila, that's. Oh, Pooja, you have reached one step further. Better determine. Just Ginny, your answer is right, beta. Pooja, just don't compute the right now the amount. Only just you compute the value of P. Only just value of the P compute. Yes. Ginny and Anila, you have computed both answer. P and 1 minus P.
16.
So, okay, student. Now the answer will be 0.375. Of course, the price, this is a possibility of price rise. Now, when I say 1 minus P, the answer will be 1 minus, this is 0.625. This is the possibility of price down, probability of the price down. So we have it with us two probabilities. Okay, so we can expect what will be our expected cash flow. At the year end of one, that is next year. Okay, since we have to use the present value factor, so it will be so thus the value of vacant plot is equal to rupees 202.
201, sir.
201 it is coming. Oh, sorry, my mistake. Just your, I think you just recalculated. It was, sorry, 201. Yes, you are right. 201 point. Anila is saying, sir, when you are turning that side, voice is not coming. Okay, which side? Okay. I think I have to keep my all the papers on side. Okay, Anila, beta, I will ensure. Okay. But once my break was my voice is break, please let me know. Okay, so that I can take an action. Okay, student. Now this question is clear to you. Okay, now we move to the second question. Just read this question carefully.
So why we have not considered the trend in the calculation of expected cash flow?
Beta, please, your voice is not clear. Please tell me.
The expected cash flow end of year one, we will just consider from then if I sell. I will not be considering 7 lakh of rent because I've already received. Is that correct, my understanding?
No, you are saying in the end of the first year. Please repeat it better.
So 7 lakh rent, we are not considering in expected cash flow just because we have already crossed that 1 year and have received that 7 lakh. Is that so, or I should add 7 lakh?
No. See, better. Here we are considering, you mean to say okay, you mean to say this is 340 lakh. One second. 340 lakh. Okay. You mean to say we are considering, why we are not considering the same? You want to know that?
Yes, sir. And even 7 lakh we are not adding. Is that because we have already passed that 1 year and we have received that 7 lakh? Is that the reason?
See, alternatively, we can say that generally, if we say that if we actually the plot we are keeping the vacant normally, or we can say that your observation is also correct. If we add you mean to say that if we add this 7 lakh like in this condition, but here student please note that your observation is correct. But here we are waiting for 1 year. Okay, because if we are waiting for the 1 year, our cash flow will be this much.
Yes, sir.
Because we are waiting for the market condition. So if we are waiting for the market conditions, so it means we are not getting the rent.
Yes, sir.
Okay, got it? Because see, we are waiting for the, normally what is happening, we are want to know the value of the vacant plot. Okay, so once we want to know the value of the vacant plot, so we are presuming a condition if our market will be buoyant. Okay, our cash flow will be 340 lakh.
Yes, sir.
If the market will be sluggish, our payoff will be 150 lakhs. So two possibilities we have come out.
Yes, sir.
So that's why we are multiplying here 340 lakhs. Okay, only for the purpose of computing the probability, we are here adding the rent. That is, I am investing 80 lakh as an investor. Okay, after 1 year, this will be my overall inflow. After 1 year, this will be my inflow. Only to know this probability, I am adding the rent here.
Okay, sir.
Okay, got it?
Yes, sir. Yes, sir.
Okay. Even if you are still doubt, you can contact me on the telephone after the class. Don't worry.
Yes, sir. Got it, sir. Clear, sir.
Okay. Thank you. Now we are moving to the second question. It says that Ram Chemical is in a production line of chemical and is considering a project of building new plant to produce pesticides. The PV present value of the new proposal is rupees 150 crore after considering scrap value at the end of life of the project. Since this is a new market, survey indicates the following variation in the present value. Condition favorable in first year, present value will increase 30% from the original estimate. Conditions sluggish in the first year, the present value decreased by 40% from the original figure. In addition, Rama Chemical has an option to abandon the project at the end of 1 year and dispose of it at rupees 100 crore. Now this is the option. This is the option has been given to you. If the risk-free rate of interest is 8%, then what will be the present value of the put option? But it has given you the indication that it is a put option. Now, if in the question, it can also be asked, what is a kind of a option? If they have just simply not mentioned this line, then they can ask what type of option will be this. So your answer should be that it is a put option. Okay, now let us draw out a decision tree, okay, or payoff tree. Then we came to know it. Sometimes it is also called the decision tree or payoff tree. Both way we can use it, and it is just equivalent to today our NPV is 150. Okay, our NPV is 150. There are two possibilities. It can be 150, 195. Okay, because we can say that it is here, it is likely to be 30% more than it. Okay, so 30% more than it means 45 addition. 45 addition will be there. Okay, or it can decrease by 40. So it means it will be 90 because it will be downfall of rupees 60 lakh, 60 crore. Okay. Now, if say here our NPV is 95, 195. Okay, because from the depending on the market condition, if it is there. So we shall continue the same. We shall continue our project. We will not sell it. Okay. So payoff from the option will be 0. Payoff from the option, that is we are not exercising our option to abandon the project. So our payoff option will be 0. And if the market conditions are sluggish, okay, so what we shall do? We shall dispose of the project and our payoff will be 100 minus 90. Okay, we are selling the project. Okay, because since we are selling the project, so whatever our NPV after 1 year, we are surrendering it to other party and our net gain will be 10 crore. Okay, because this NPV will be expected in the forthcoming years. Please remember it. This NPV will be expected. So it is a kind of opportunity cost, or we can say it is kind of a surrendering that we are our NPV. So ultimately it is kind of a cost for us. So it will be our 10 lakh, 10 crore. Now this is kind of a, again, which formula we shall, or which logic we shall use here?
Risk neutral again.
Risk neutral again. Very good. So again, we are assuming this is P, or this is 1 minus P. Okay, now let us compute the risk neutral method. Okay, here we will not use the value, only just we shall use our this logic 30% down, up, and 40% up, and our risk-free rate of interest is 8%. Well, otherwise we can also, both we can also use. I will show you by both way. Okay, suppose if I am using by amount, so today my NPV, or we can say my present value, is 150 P into 195 plus 1 minus P into 95. Sorry, 90.
90.
Yeah, yes. Okay, and present value factor I am multiplying, or other way I am also saying, say that 8% I am getting, we can say probability is that 30% up or minus 40% down. Both way I can compute the, in the study material, I think this approach has been followed, or I'm just same approach, answer will be the same in both cases. Okay, now compute the value of P. I'm waiting for 2 minutes. Very good, Anila. Your answer is correct. Just share it on the chat. Yes, other option will be this much. Sahil, yes, your answer is correct. All this small rounding of difference, it hardly matters. Don't worry about the same. Yes, Ginny, you are correct, beta. Yes, other part as well. So student, our P will be 0.86857 or 0.686. Up to 3 digit it is valid, no problem. Okay. Now once we have found out once the probability has been found out, has been computed, we shall now value the abandonment option. Okay, so expected payoff at year 1, P into 0 plus 1 minus P into 10, that is equal to 0.6860 plus 0.314 into 10. Our payoff will be 3.1 crore at the end of 1 year. Okay. Since it is expected payoff at year 1, the PV of expected payoff will be 3.14 divided by 1.08, and it will be rupees 2.
2.91.
Yes, better, 2.907 crore. So this is the value of the. Now, if I ask you in one additional question, what will be the value of the value of the project with the option? Okay, if I ask you, what will be the value of the project with the option? Here you can see that our NPV is without option, its value is 150 crore. Okay, so since our value of option is rupees 2.907 crore, the value of the project will be rupees 150 crore. Yes, 152 crore plus 2.907 crore. So even this question can be asked. Very simple. You have just to apply the logic that I have discussed. Whatever the option value we are getting, we are adding same. And if we have to pay some premium or something, that we normally minus. Okay, because this is a kind of a right. We are getting, we can say that, see, if we see the question, this basically the right of getting, this is selling disposal right of rupees 100 is only the way out, that is we are getting some option. Okay, that is we are getting the option. Otherwise, it becomes a very simple logic. And if you recall that in a decision tree type of a question in capital busting, normally we just used to compute the payoff, etc. Okay, but here we see that we can compute our options, how it moves, like because we are given the option. Okay, okay, students. So what we do before I think next question, we can take a small break because it will take some time. Okay, after that there are two questions have been left. We will now this is 8:21, so we will assemble at around 8:32 or 8:33. Okay, student, we take a small break. Okay, then we meet again. Break starts. Okay, students, welcome after the break. Now let us start our question number 3. Just I have received. Okay, thank you, beta. Thank you, Pooja. Thank you. Thanks a lot for appreciation. Now we come to the question number 3. Let us quickly read this question. One second. Now it says that suppose MIS Limited electricity generating plant for the light, for lighting, or we can say for the light of the staff quarters. The plant shall cost rupees 252.5 crore and shall lead to a saving of electricity expenses at the current tariff by rupees 21 lakh per year for the 4 hours. Okay. Now, however, after 1 year, with a change in the government in the state, the rate of वॉइस नहीं सॉरी वॉइस नहीं आ रही बिल्कुल आ रही है आप नहीं आ रही रुको एक मिनट अब देखना अब सही है ओके नाउ स्टूडेंट सॉरी फॉर द वॉइस इशू suppose MIS Limited is considering installation of solar electricity plant of light for light of the staff quarters. The plant shall cost 2.5 crore and shall lead to saving in electricity expenses at a current tariff by rupees 21 lakh per year 4 hours. So when it is a 4 hour, we can say it is a kind of a perpetuity. However, after 1 year, with a change in the government and state, the rate of electricity is subject to change. Accordingly, the saving in the electricity can be rupees 12 lakh or rupees 35 lakh per year and forever. So again, forever means it is in perpetuity, and these two possibility indicates our basically binomial model. Assuming WACC of the MIS Limited 10% and risk-free rate of return is 8%, decide whether MIS should accept the project or wait and see. Okay, now student, please see here. In this type of a project, there is one particular situation, and that situation is that they want to install a plant to electrify, or we can say to lighting the project to flats. Here they have an exclusive right. Okay, they have an exclusive right. They are not any competitor other that will come and join the business. Okay, so we can say here, because of this exclusive right, they have only what they have to decide. They have to decide whether we should install the plant now or whether we should wait for 1 year, as because after 1 year, due to the change in the government, the electricity tariffs are likely to be changed. So let us see how we proceed with the answer. First of all, we shall calculate the as on date. So first of all, we can compute an NPV as on date. At cost of capital of 10%, the value of saving forever, that is perpetuity. Okay, now we compute NPV, simple. Since 2.5 crore is our cost of the plant, okay, now if we see the present conditions, okay, we shall not accept the project because NPV is our negative. Now we should wait and watch. Nisha, my voice is clear now?
Yes, sir.
Okay, okay. Now we come to the second scenario. We can say since NPV is negative, at present we should not accept the project. Now we come to the second part, that is after 1 year. First scenario, if price of electricity increases, okay, at WACC of 10%, the value of saving forever. Student might be thinking, sir, there are two rates have been given. One is WACC, another is risk-free rate. Student, please have some patience. We will also use the risk-free rate. Okay, where we use, we shall see. Okay, the position of the NPV will be as follows. So it is, we can say it is a positive, it is a good sign. Okay, and rate of return we can say now second scenario, if price of electricity goes down, the value of saving at the WACC will be equal to rupees 12 lakh crore. Okay, this will be, the position will be of NPV revised, and it will be minus rupees 1.3 crore. True. Now better, we can say that return percentage so diagrammatically it can be shown below. We can say there are two possible scenarios. Okay, so as usual, which method we shall use?
Binomial.
A binomial model. In binomial model, which method? Delta hedging or risk neutral?
Risk neutral.
Risk neutral. We have to find the probability. Now, when we have to find out the probability, we need the risk-free rate of return. We need the risk-free rate of return, and that has also been provided to us, and that is 8%. Okay, friend, with this, we now let us compute our probability of price increase as well as price decrease of the electricity. Okay, so P1 minus P. So I can say, simply say like that. 8% is equal to my return. My expected return is 40. Okay, and the probability is P. My expected return is minus. Sorry, I'm just writing it. I'm just converting into percentage, then I will convert into this. It is, we can highlight like that, 40% into P plus minus 52% into 1 minus P. Okay, or I can write like that. Okay, friend. Now just compute the value of P. Okay, this. Anila, just compute it again. Let other student also compute. Minus 22. Any other student just send the response. I consider value 2.5. Which value to? Okay, from 2.5. 2.5, you are considering the value.
Sir, I took instead of percentage 2.5 is equal to 3.5 into P. My 1 minus P into minus 1.2.
Okay, from this you are getting this answer.
Yes, sir.
Let me check better, because if the answer should be the same,
Oh,
because
sorry, sir. I excluded one thing. I'll
yeah,
recompute and tell you.
yeah, that's it. Mhm. Yes, Ginny, your answer is correct. Sahil, I think what are you writing? It is not in probability terms, because probability, Ginny, yes, other probability as well. Sahil, your probability is not in decimal point. It should be in decimal point. And just recheck it again. Okay, so student, our probability is coming 0.652. That is the probability of rise. Okay, and probability of, that is 1 minus p, probability of fall is equal to 0.348. Anila, probability. Anila, again you are getting 0.83.
Yes, sir. Yes, sir. I divided by 1.08 because we are taking that risk-free as 0.8.
So no,
Sir,
you are dividing. One second. If you are saying our investment, let me check better, um, because here our return is, because see, maybe that reason you are considering those figure, I think.
so your voice is breaking, sir.
Okay,
Sir.
now it is clear now.
Yes, sir.
Now I think you are considering the gross figure. You have to deduct the quote as well.
So can you just put means give me the formula with that value 2.5?
You can get say 1 crore, okay, divided by 2.5, because see, you are doing 3.5 crore divided by 2.5 maybe.
On the screen.
Yeah.
Can you please walk it out with 0.5 scores on the screen?
Okay, I do one thing right now. I just continue the answer. Okay, if in the end of the class or separately, I will show you. Give you next class. I will give it. Okay,
Okay, sir.
because I right now. Okay, let the other student continue. Then I will discuss with you. Okay, because we can say that, like, we are investing. Okay, students. So with this, yeah, this is our probability. Okay, now expected payoff. (0.652), and our expected payoff positive 1 crore rupees plus 0.348 into our negative payoff of rupees 1.3 crore rupees. Okay, so our value comes 19.96 lakh. Okay, so this payoff is expected at the end of 1 year. Okay, so we have to compute whether we should accept the project or wait and watch. So our PV, if we compute the PV as well, Sorry, it is initially discounted by the 10%. Just compute what is the figure better.
$18.14.
18.14. Okay, beta, it is 18.14 crore lakh we shall use here. So of course we should wait and watch. Okay, now Anila, you were saying that your answer was incorrect because I'm writing conclusion first. Then we should wait and watch as positive. The NPV will be positive after 1 year. Okay, Anila, just what we were
Sir, here we should divide by 1.08 now. Why we use 1.1?
see whether in the study material we have given 1.08, but we can see that it is a back cover is 10%.
Sir, but when we calculate probability by using 0.8,
Okay. When you mean to say we have to use present value, that is a discount because it is a no. If we are see your point is correct. Now here we are computing the NPV value as on date. Okay. If we have to compute the value of option, okay, madam, then we
Yes,
will
sir.
do 1.08.
Okay, sir.
Okay, if we have to compute the value, if it is asked what is the value of the option, what is the value of call option? Okay, either way you can use both. Any rate you will use, answer will be correct. No problem.
Okay, sir.
Because we can consider it from the option point of view as well.
Sir.
Okay. Or you have any doubt, please discuss. No problem.
No, sir.
Okay, because if we ask, we have to compute the value of the option of wait and watch, then we can see that it is we have to divide it by 1.08, no doubt. Okay, or otherwise you can also divide by the 1.08. Both answer will. Okay, Veena?
Okay, sir.
You were saying better you got the answer by using 350, na?
So your voice, sir.
Okay, you were saying that you were computed the answer by 350 using gross
But it's
figures.
the diagrammatical this thing we put 2.5 will increase to 3.5 and negative 1.2.
Okay, but we have to see the gain here. If we see the gain, how much we are investing today?
2.5.
2.5 I am investing today. Okay,
So I have to take 1 and negative
that is
1.3.
yeah. Then I think your answer will be correct. Because
Okay,
here
instead of 3.5 and negative 1.2, I have to take 1 and negative 1.3.
there will be one possible 1.2 possible. This will be figure one that will be 1 crore positive.
Yeah, 1.3 crores negative.
Negative. Then your answer will be there.
Okay, sir, I'll just check, sir.
Then you check is if it there. Okay, because you are getting this much of return, and present value of return is like that, we can say. Or otherwise I will gross out the formula in the next class, or if the time will be left, we will discuss in the end of the class. Okay, student, now we come to the next question. That is question number 4. Now this is a question based on the strategic option. Okay, this is a question based on your strategic option. Now question says like that: ABC Limited is a pharmaceutical company possessing a patent of a drug called Edrix, a medicine for AIDS patients. Being an approach drug, ABC Limited holds the right of production of drug and its marketing. The period of patent is 15 years, after which any other pharmaceutical company produce a drug with the same formula. Generally, what happens in case of a patent, it is valid for some fixed period of time. After that, any company can use the same. The period, it is estimated that the company shall require to incur 12.5 million for the development and the marketing of the drug. As per survey conducted, the expected present value of the cash flow from the sale of drug during the period of 15 years shall be rupees 16.7 million dollar. Cash flow from the previous similar type of drug has exhibited the variance of 26.80%. Okay, now when student the variance come into the picture, in case of a binomial model, we normally take the two possibilities, that is up and down. When this figure variance come into the picture, so here you can get a hint which formula we shall apply. Now let us see, proceed further, then you will come to know. 26.80 of the present value of the cash flow. The current yield on treasury bond of similar duration of the 15 year is 17.8. We have to determine the value of the patent. Now here, this type of a strategic decision, we normally keep it equalized, or we can say we make it parity with the call option. So call option, we normally use the two models. One is binomial, and of course under this the risk neutral model we have used in our previous questions. Now here there are no such possibilities that is there are prices going up or prices is going down. Here we have been provided with the figure of variance. Okay, now student, please tell me which method we shall use here.
Black-Scholes.
Yes, Black-Scholes model. Very good, Ginny, and very good. And other student, I could not put your name.
Pooja.
Yeah. Okay, madam. So both of these models, because here we have given the hints, that is a variance is there and risk free. So all other factors have been given to us. So here we shall use this model. But here, when we shall use this model, there is a specific version of the same. Of course, in financial option, we have used the model, but here slight variations have been made. And what are these slight variations? We will notice in our forthcoming discussion. Okay, now let us students proceed further. Okay, now let us see how we use the Black-Scholes model here. Now, first of all, some of the inputs that are required for Black-Scholes model are: first, the spot price. Okay, generally it is equalized to the present value of cash flows. So this is our present value of cash flows. Then exercise price. Cost of developing the formula. Variance of cash flows. (26.8%), or we can say it is this. Here there is one more factor, two more factor, risk-free rate of return. R has been given to us 7.80%. There is one more factor, that is dividend. Or we can say it is a kind of a expected cost of delays. It shall be 1/15. Now, student, normally what happens? See, we have been given the option that this patent will be valid for 15 years only. Okay, after that, anyone can use it. Now, more and more we delay the patent. Okay, because we have been given the right for the 15 years. So we are losing our payment. If next year I apply, you start my R&D, okay, so my return will be, of course, 1 year less. So next year this dividend will be 1 divided by 14. Okay, next year if I do it, it will be 1 divided by 13, because with each year I am losing this much of portion. So this is considered as a opportunity cost, or we can say it opportunity of dividend. Now we compute the value of call option. Here we shall use a slightly different version. E raised to power minus dt. I think if an earlier formula, it may not be there. That is risk. R is risk-free rate of return. Here we are considering dividend. So these two factors are multiplied here. Of course, this factor is multiplied in our financial option as well. Sorry, here I have to write ND1. ND1 I forgot mentioned here. And this is ND2. Okay, student, now we compute the, here this value I forgot, you just add the same. Now here we compute first, we compute the D1 values, natural log, this is the dividend version. Standard deviation into square root of the time. Accordingly, D2 is okay. We shall use the formula that we have explained here. We will keep the values. 1 second, I just write it again. It is correct. I have written only just I am for the space sake of space. I am writing it again. This is 0.268 to 15. Okay, natural log value has been given to us. We can put the value there. Student, if any value is wrong, please do let me know. So D1 comes 1.2315. Accordingly, D2 value will be 1.2315 minus 2.005, and it will be minus 0.7735. Okay, student. Now we have to compute area under normal curve. Okay, so we have been given these values. Sorry, student, just correct this. It will be area, cumulative area. This is my mistake. This is just my cumulative area under normal curve. Okay, now we have given the cumulative area. Now let us find out the area. We have to use here the interpolation because we need area under two factors. That is, one is 1.235. So the value will be lying here between. In between these two values, we have to find the values. Okay, now let us see how we use the interpolation. For the value of 1.23, the cumulative area under normal curve is 0.8907. Okay, for the 1.24, area under normal curve is 0.8925. If we see the difference, that is, we minus it. Okay, we minus this 0.018. So accordingly, we can find out the difference. See, we need the value of 1.235 we have with us the value of 1.3. So we need the value of area for the equivalent value of 0.0015. Okay, for this z value, we have to compute the area. So now this factor is with us 0.01. Accordingly, we can say that for 0. This value, we can compute it like that. For 0.01, the equivalent area under normal curve is 0.18. For 1, it is 0.018 divided by 0.1. Okay. For 0.015, okay, the equivalent area will be okay, students. So this will be area. Now here ND1, that is ND 1.2315 will be equal to 0.8907 plus 0.0027. Okay, the equivalent area will be 89097, or we can say 0.8910. So this will be the equivalent area. Okay, student. Now we proceed to further to compute ND minus, how many value we have, what we have to compute? This is minus 7735, 0.7735. Okay, or we can say that, or 1 minus n 0.7735. We can interpret it that way also. Since we have been given the positive values here, these values are positive. Okay, but we have to compute the area of negative value. So what we do, we compute the area by using the positive values, and we will deduct it from the 1. Again, let us compute the interpolation formula. Okay, as we have there for 0.10, this factor is okay. We need the value equivalent value of, we require this much. So we multiply here. So we can say that 0.029 divided by this. Okay, the value comes 0.01015. Okay, for ND1, that is N, this value, not ND1, this is N area under normal curve for this value. Okay, so what we do, we deduct it from the this. So our area will be ND minus 0.7784 will be 2196. Okay, students, so we have calculated the area under two factors. Now we shall use the value. To compute the value, we shall compute value of patent. Now we shall use our that model that this equation we shall use okay. So what we do, okay, I do one thing, I write the formula again so that it will be easy for us. So spot price, we can say it is 16.7 into e raised to power minus 0.0667 into 15. Our T is 15. Area under our ND value was, this was the area of ND1 plus exercise price into e raised to power minus 0.078. Duration is 15 year into, now we compute this value. We put value this here. This value is 0.2196. Okay, this value and this value, let us see, 16.70 into, this value has been given to us. If you see in the question, okay, so we can see here that, let us write e raised to power minus 1.05 student, there is error in the values given. I think it should be minus, it should be minus. Student, make small correction. Here this minus has been forgotten to prefix. Okay, so minus 1.05 plus 12.50 into e raised to power minus 1 point this into 0.2196. This is ND1. This is 1 second. Our value was here. Sorry, my mistake. I forgot to add here into 08.90 this. Okay, plus 12.50 into so now we make the computations 5.471. Student, just start computing the values. If I am wrong, so just correct me. Okay, student. Now this value will be 0.852. Accordingly, this value will be, oh sorry, not 4.619. So we can say thus the value of patent is 4.61. Okay, student, now it is clear. So we can see how we have applied the Black-Scholes model for the valuation of patent. That is our strategic decision. So student, now just I am quickly I'm finding out, because Anila, your answer here was different. Somewhere I think Anila, can't we say like that if you are here?
Yes, sir. Yes, sir.
Can't we say like that if we are investing 250 today? I'm just writing with a different pen. Sorry. Can I write like this? If I am investing 250 lakh today, 2.5 crore today, okay, my return is likely to be 1 crore after 1 year. The probability is like that, plus it is negative 1.2 crore.
3, sir.
Oh, sorry, 1.3. Okay, 1.3 into 1 minus P. That way, if I equate divided by the complete equation divided by 1.08. Can't this way we find the answer?
We'll just check, sir. 1 minute.
And you just check the answer, because that will be the approach.
We get same answer, sir.
Get the same answer, na? No, wrong answer. It is a 6.5 or different?
No, sir, we are not getting this.
You are again getting, let me check.
Because 2.5 multiplied by 1.08 only will come to 2.7. And this side we will be adding that due to the sign change. I'm getting it as 4 divided by 2.3.
So your answer is coming, P is coming.
No, sir, P is coming more than 1.73. Then it would be wrong, right?
More than one. 1 second, 1 second. Let me check. I think then it will have to be it that way. 2.5 crore. Your observation is correct. Let me check. 1.53 minus. Let me check better. Just let me check 1 second. 1 point. Because if any other student can even try if they are getting the same wrong answer. Just it is 2.5 into 1.08. It is 2.7 equal to 2.7 equal to P minus P minus 1.3 plus 1.3 P. Okay, so it is getting 2.7 to 1.08, 2.196 plus 1.3. 1 second. One second, students. I'm just getting the answer. 2.7 into 1.08 plus 1.3. How it is possible? 1.3 equal to 2.4.216. Yes, you are getting your probability is more than 1, na?
Yes, sir.
Okay. Let me check. I have to check it other way around.
Maybe the negative sign would change or something is what I was
I think just
thinking
you
of.
change the negative sign. Okay, you change the negative sign, then see the answer. I think then it will be the correct one.
But I did not get the exact answer. There is some
Okay, no
difference.
problem. I will check it on my office. Okay.
Yes, sir. Yes.
Then I will see them. Okay, I will revert it to. Okay.
Yes, sir.
So, okay, student. I think with this we can end up the session. Okay, if any student has any query relating to them, and in the end, just I want to summarize. If I say summarize one thing, we can say that the model that we have discussed, binomial model, risk neutral model, and Black-Scholes model. So we can see that these are the three models that are discussed in the financial option. But here we have seen that normally these are two are widely used for computing the real option. So we can see that a financial option replicate a underlying when it's replicated by the projects, then it becomes the real option. So student, if you have any query, then discuss with me. whether we yes, Pooja,
Sir, can you just go back to that slide where we were doing that calculation?
this way.
सर वो पे ऑफ के साथ हमने जो कैलकुलेशन करके देखा था और पी मैच नहीं हो रहा था.
अच्छा बोला, अच्छा अच्छा
हम्म.
आई थिंक ये वाला कह रहा हूँ ना बेटा.
जी
हाँ हाँ हाँ.
सर, अभी जैसे मॉड्यूल में उन्होंने दिखाया था जिसमें हम पे ऑफ के साथ अगर कैलकुलेशन करते हैं तो अपने वो जो डिस्काउंटेड प्राइस आती है 1.08 उसमें से -1 करना चाहिए शायद.
-1 करना चाहिए. एक्चुअली मैं बेटा इसको थोड़ा देखूंगा. अभी मेरे को इस टाइम पे थोड़ा सा ना, अभी नहीं हो पाएगा मेरे से. ठीक है ना,
ओके.
एक बारी मैं थोड़ा उसको नए सिरे से देख के उसका अल्टरनेटिव डालूंगा फिर स्टडी मटेरियल में. ठीक है ना,
ओके.
और
जी
पॉसिबिलिटी भी
जी
रहेगी, क्योंकि उसमें आप एक बार घर पे थोड़ा ट्राई करेंगे ना, इसको हो जाएगा आराम से, वैसे कंफ्यूजिंग
जी
नहीं है
जी.
इसका. ठीक है ना, हो जाएगा.
ओके सर.
So, acha, okay, student, one more thing. Since our derivative topics, we have thrown with the derivative topic, and there is one more class has been scheduled next class. So please note that this class will not take place because we have covered all the topics of the derivatives. So maybe there may be announcement that this class has been cancelled out due to some reasons. So, but after this class, that is and one after this is next class, there will be no class. After this, we shall start the topic of foreign exchange exposure and risk management. So, of course, but please check out the schedule on tomorrow. You again recheck the schedule. So, of course, if the class of derivative has been mentioned, so there will be no need to attend this class. But you start attending the classes from the topic of the foreign exchange exposure and risk management. So, students, with this, we come to the end of the session. If you have any query, okay, if you have any query, of course, you can send your query that email. And one student has asked, sir, share your email and mobile contact number. Now, this is my contact number. This is STD code. Okay, or you can send us your query at sfm-final@icai.in. Okay, so you can send your query, your email, or even mobile app reason. So, students, so see you in the next class on the topic of the foreign exchange exposure and risk management. And meanwhile, revise what we have discussed in this topic of the derivatives. And with your query, you are free to ask. Okay, student. Thank you
Sir.
very much. Yes.
सर जो अभी ब्लैक स्कॉल से मॉडल सॉल्व किया था और
हाँ.
उसमें अगर ये ND1 और ND2 की जो वैल्यूज आती है 0.7 0.778 ये वैल्यूज अगर एग्जाम में गिवन नहीं है
आप छोड़ देना वहीं पे
तो
आंसर.
सर छोड़ देने से थोड़ा क्वेश्चन में
नहीं
मार्क्स.
नहीं. See, beta, what happens? These value you cannot remember. Okay. Otherwise, if in the examination you have been provided with the table, normally which is not provided,
यस सर.
so you can leave. Don't worry about the same. See, normally it is assumption in the examination that whatever we can solve it on the simple calculator, that is allowed. See, I just give you a very simple example. Sometime in the examination, they may ask you one computation like this: 500 divided by 350 raised to power 1 by 3. Okay, of course, there are some calculations, very long calculator calculation, and student compute the answer. We normally don't expect the student to compute this value. Okay, even you leave the answer here, you will award the marks. But up to this calculation, you should be right. Are you getting on my point or not? Up to
यस सर.
this calculation, you should be right. Otherwise, if nothing can be computed on the simple calculator, you are not supposed to do it. Okay, like value of say exponential. That is very is a very good question. Now, like this value in a option valuation, this E value has not been given.
वैल्यू यस सर. ई वैल्यू
Built by the simple
0.27.
compounding. Okay. Use
सर
simple.
लेकिन मॉड्यूल में वैल्यू गिवन है ई की 2.718 करके.
हाँ.
तो उससे कुछ कैलकुलेटर से निकलती है वो. मतलब आई एम नॉट परफेक्टली गुड इन दैट कैलकुलेशन
नहीं
बिकॉज
नहीं नहीं, आप मेरी
समटाइम.
बात सुनिए बेटा. If value has been given to you in of exponential, तब कोई प्रॉब्लम नहीं है।
ओके
अगर नहीं दे रखे आप सिंपल कंपाउंडिंग लगा देना, तब आपको हम एक्सपेक्ट नहीं करते कि आप बच्चा एक्सपोनेंशियल की वैल्यू निकालेगा।
ओके सर
ठीक है ना, क्योंकि एक्सपोनेंशियल वैल्यू नीड टू बी गिवन,
ओके सर
उसमें हम किसी को डिनाई नहीं कर सकते हैं। ये वैल्यूज कोई बच्चा, ये बच्चा कोई वैल्यूज, अब इवन जैसे पीवी फैक्टर है, इफ यू अंडरस्टैंड, इवन पीवी फैक्टर है, तो पीवी फैक्टर हमारे कैलकुलेटर पे निकल जाता है।
यस सर
अगर आप देखेंगे बहुत पुरानी किताबों में, ओल्ड बुक्स में, वहां पे पीवी फैक्टर दिया रहता था टेबल के साथ, क्वेश्चन के साथ। उसका रीजन ये था कि उस टाइम पे कैलकुलेटर्स नहीं होते थे, तो स्टूडेंट्स को सारी कैलकुलेशन मैनुअली करनी पड़ती थी, वो पीवी फैक्टर निकालने में टाइम लगता था। तो अभी क्या है, आपका कैलकुलेटर पे पीवी फैक्टर इजीली निकल जाता है। और जो
यस सर
अभी जो क्वेश्चन दिया जाता है, टेबल जो टेबल में दी जाती है वैल्यू, कई बार आप क्वेश्चन के साथ देखेंगे, वो इसका पर्पज ये होता है कि बच्चों के आंसर वेरी ना करें, क्योंकि कोई बच्चा 3 तक वैल्यू लेगा, कोई 4 तक लेगा। तो देने का पर्पज ये होता है कि आंसर सबके सिमिलर रहें, और वही आपने वैल्यूज यूज करनी है।
ओके सर
ओके। और अगर मान लो कोई वैल्यू गलत भी है, तो हम दोनों वैल्यू मानते हैं, अगर बच्चे ने ठीक वैल्यू भी ले ली, वो भी, उसको भी मार्क्स मिलेंगे, और उसने अगर गलत वैल्यू से भी आंसर कर दिया, उसको भी हम मार्क्स देंगे। दिस काइंड ऑफ लिबर्टी वी डू इट।
ओके सर
ओके मैडम। ओके स्टूडेंट, एनी मोर डाउट? Okay, students. Then see you in the next class of the foreign exchange exposure and risk management. This is one of the very important topic from the examination point of view, as well as from practical point of view. So see you in the next class. And thanks for patient listening for today's session. Thank you very much. Have a nice day.
थैंक यू सर।
Thank you.
Thank you, sir.
Thank you. Thank you. Yes, session over. Thank you.